Investing for beginners. Everything you need to know to get started. Most people think investing is for people who already have money. It's not. Investing is actually how ordinary people build money over time. And the earlier you start, the less you need to put in to get there. Today, I want to cover everything a beginner needs to know. What investing actually is, why you need to start, even if you think you can't afford to, the different types of investments available to you, how to actually get started with whatever amount you have right now, and the mistakes that trip most beginners up. And throughout this video, I want you to meet Max. Max is 26, just landed his first proper job, earns 18,500 Rand take home per month, and has never invested a single Rand in his life. By the end of this video, Max will have a clear plan, and so will you. Welcome to Pulse Point. I'm a chartered accountant working in banking, and investing is something I work with every day. But I also remember what it felt like to look at all of this from the outside and have no idea where to begin. That's exactly who this video is for. Part 1. What investing actually is. Let's start with the basics. Investing is simply putting your money to work so it grows over time. Instead of your money sitting in an account doing very little, you put it into something that has the potential to increase in value. And that growth compounds over time. The key word there is compound. Compounding means you earn returns not just on your original amount, but on the returns you've already made. It sounds simple, but the effect over time is extraordinary. Here's Max's situation. Max has 500 Rand a month he can put aside after expenses. He's 26. If he invests that 500 Rand every month and earns an average return of 10% per year, which is roughly what a diversified equity fund has historically delivered over the long term, by the time he's 65, he'd have close to 3 million Rand from just 500 Rand a month. Now here's the part that really drives it home. Max's friend Sean waits until he's 36 to start. Same 500 Rand a month, same 10% return. By 65, Sean has just over 1 million Rand. 10 years of delay cost Sean nearly 2 million Rand. Not because he invested less, he invested the same amount every month, just because he started later. That's the power of compounding. And that's why starting early matters far more than starting big. Part 2. Why most people don't invest and why those reasons are wrong. When Max first heard about investing, he had 3 objections. I hear these from almost everyone. The first was, I don't have enough money. Max looked at his budget after rent, food, transport, and subscriptions and felt like there was nothing left. But here's the thing. Max wasn't looking for 5,000 Rand a month. He was looking for 500 Rand. And when he actually tracked his spending, he found he was spending 600 Rand a month on eating out alone. One small adjustment and the money was there. You don't need a lot to start. Many platforms in South Africa allow you to begin with as little as 500 Rand a month or even less. The amount matters far less than the habit of starting. The second objection was, it's too risky. Max had heard stories of people losing money in the stock market and it scared him. But here's what Max didn't consider. And not investing is also risky. If your money is sitting in a savings account earning 4% while inflation is running at 6%, you're losing 2% of your purchasing power every year. That's a guaranteed loss. The risk of not investing is just as real. It's just less visible. The third was, I don't know enough. This one I understand most. The financial industry has done a brilliant job of making investing seem complicated. Max didn't need to understand every product, every market, or every economic indicator. He needed to understand a few basic principles, which is exactly what we're covering right now. Part 3, the different types of investments. Let's walk through the main investment types Max and you need to know about. Cash and cash equivalents. This is where Max currently keeps all his money. Savings accounts, money market accounts, fixed deposits, low risk, low return. These are not really investments in the growth sense. They're places to park money you might need soon. Max has his emergency fund here. That's correct. His investment money needs to go elsewhere. Bonds. When you buy a bond, you're essentially lending money to a government or company in exchange for regular interest payments. Lower risk than shares, more predictable returns. South African government bonds are considered relatively safe and can form a stable part of a portfolio. Shares or equities. When Max buys a share, he owns a small piece of a company. If that company grows, his share grows in value. If it pays dividends, he receives a portion of the profits. Shares carry more short-term volatility than bonds, but over the long term, they have historically delivered the best returns. The JSE, the Johannesburg Stock Exchange, is where South African shares are traded. Max doesn't need to pick individual shares though. We'll get to that. Unit trusts and ETFs. This is where Max is going to start, and probably where you should too. Instead of buying individual shares, you buy into a fund that holds a basket of many different shares or bonds. This gives you instant diversification. ETFs are low cost, easy to access, and available through most major platforms in South Africa. Property. Max dreams of owning property one day. REITs, real estate investment trusts, allow Max to invest in property through the stock exchange without needing to buy a physical property. Something to consider as his portfolio grows. Retirement annuities and tax-free savings accounts. These are the two structures Max wished he had known about sooner. A tax-free savings account allows him to invest up to 36,000 Rand per year, completely tax-free. No tax on growth, no tax on withdrawals. A retirement annuity gives him a tax deduction on contributions and lets his money grow tax-free until retirement. Both are powerful tools most beginners overlook. Max is starting with both. Part 4, how Max actually got started, and how you can too. Here's exactly what Max did. Follow this and you'll have your first investment in place by the end of the week. Step 1, get your finances in order first. Before Max invested a single Rand, he made sure he had an emergency fund. 3 months of expenses sitting in a money market account. For Max, that's about 28,000 Rand. He also had a small personal loan from a furniture store charging 22% interest. He paid that off first. The 22% he was saving on interest was a better return than any investment could offer him right now. Step 2, open a tax-free savings account. Max went to Easy Equities, one of the most beginner-friendly platforms in South Africa. He opened a tax-free savings account in about 15 minutes with just his ID and bank details. No minimum balance, no complicated paperwork. If you haven't done this yet, this is your first step. Step 3, choose a simple diversified fund. Max didn't try to pick individual shares. He chose 2 ETFs, the Satrix 40, which tracks the top 40 companies on the JSE, and the Satrix MSCI World ETF, which gives him exposure to the largest companies globally. Simple, low cost, well diversified, he didn't overthink it. Step 4, set up a debit order. Max set up a 500 Rand monthly debit order on the 26th of every month, the day after his salary comes in. The money goes in automatically before he has a chance to spend it. He doesn't think about it. He doesn't have to remember. It just happens. Step 5, leave it alone. This is where Max struggled at first. 3 months after he started, markets dropped and his 1,500 Rand investment was sitting at 1,380 Rand. He felt sick. He wanted to sell. He didn't. 6 months later, his portfolio was at 3,200 Rand. The market had recovered and his monthly contributions had continued through the dip, which actually meant he was buying more units at a lower price. That's called Rand cost averaging, and it's one of the hidden benefits of investing consistently through market movements. Part 5, the mistakes Max almost made. Before we wrap up, let me flag the most common mistakes I see beginners make, because avoiding these is just as important as getting the basics right. Waiting for the perfect time. Max spent 3 months researching before he opened his account. He kept telling himself he'd start when markets settled down. There is no perfect time. The best time to start was yesterday. The second best is today. Putting all your money in one thing. Max's colleague told him about a cryptocurrency that was going to 10 times. Max almost put 5,000 Rand in. He didn't. Not because crypto is necessarily bad, but because putting a large chunk of your first investment into a single speculative asset is not a strategy. It's a gamble. Panic selling. Max almost sold when markets dropped. He didn't. That decision alone saved him hundreds of Rands in lost returns. Chasing hot tips. If someone is telling you about a guaranteed return or a can't miss opportunity, walk away. There are no guaranteed returns in investing. Anyone promising them is either wrong or dishonest. Ignoring fees. Max almost chose a unit trust with a 2.5% annual fee because it had a nice looking app. He switched to an ETF with a 0.1% fee instead. Over 30 years, that difference in fees could cost him hundreds of thousands of rands. Always check the total expense ratio before investing. In closing 6 months after opening his account, Max has 4,200 Rand invested. It's not life-changing yet, but the habit is in place. The debit order runs automatically, and compounding has started doing its quiet work in the background. He didn't need a finance degree. He didn't need a lot of money. He needed a decision, a platform, and the patience to leave it alone. That's all investing is at the beginning, a decision followed by consistency. If this was useful, subscribe to Pulse Point. I put out a new video every week breaking down personal finance in a way that actually makes sense. And drop a comment below. I'd love to know where you are on your investing journey. Are you a Max who's just starting, or have you been investing for a while? I'll see you in the next one.